Hey everybody, Cowboy here. Today we have a quick talk on how interest rates can affect the upcoming presidential election. If you stick around after the video, there's a little bit of information on how to find us. You could also zap that QR code at the bottom of the screen or go to the website and learn about who we are and what we do. In the meantime, enjoy the show. So we just got some data in, and I'm going to be looking for some trades. Today, let's refresh the screen and see how the economic data came out. What we've been noticing is that you get the data and then it gets revised, right? And I know we've been talking about this for weeks, but the data comes out to make the economy, typically, at least from what I'm reading and seeing, the data comes out to make the economy look strong because they are headed into an election year. So they'll have the economy look strong, right? But here's a problem with that. As long as the economy looks strong for the economic data, then the wisdom is that they're going to continue to hike rates. And the people in power right now are going to have a hard time because when you hike rates, money gets expensive. When money gets expensive, the market does not go up. And in fact, things start to fold. We've seen some banks go down, Silicon Valley Bank, First Republic. There's been some pretty big names out there that have been having a hard time because of the higher interest rates. I think that's like kind of the root cause. A lot of these investments that have been out there, a lot of malinvestment, a lot of politically oriented investments have been doing well for a number of years because money has basically been free for like 14 years. I mean, they crushed, we looked at some charts yesterday on the Rogue Show, and they have crushed the interest rate down to like zero, basically. And they held it down to zero for more than a decade post 2008, right? Post the GFC. And when money is free for a decade, what you're doing is you're conditioning human beings to always buy the dip because the market's just going to keep going up because money is debt. And when money is debt, that means that the interest rate on money is going to affect how cheap it is. And when the interest rate is virtually zero, that means that for the big players who have all the friends that print money, money becomes essentially free for them. Money gets printed, it gets loaned to them at basically a 0% loan, effectively a 0% loan because of the way that the inflation is working. They get the money first. So when you get the money first, that's before it gets into the population and causes the inflation. And then what they do, the commercial banks, is they lend it out to everybody and they multiply the size of that money through fractional reserve banking. We're not going to get into that today. We've done it before on the Rogue Show. But once the money gets out there, it creates inflation. So they get the money before it creates inflation. They get the money first, they invest it, they loan it out, they position themselves. And when the money gets loaned out and expanded through commercial bank loans into the population, then the population is going to take that money. The inflation is going to take effect because the population is going to start buying stocks, they're going to start buying things, and everything goes up. That's just how it works. Because when the interest rate is low, you need to deploy cash. And the reason you need to deploy cash is that holding cash makes no sense because the interest rate is low. You're not getting any return on holding cash or bonds or anything that's related to cash. So they have to invest it to get any kind of yield. So you see these big run-ups like you've seen since like say 2012, the market has done nothing but go up. Well, we've been hiking up the interest rates. There's a lot of possible reasons and a lot of obvious reasons behind that. But long story short, now that we've hiked the interest rates, it's become less, it's become more expensive to invest in stocks. And when it becomes more expensive to invest in stocks, then the value proposition of stocks begins to matter more. And what's a value proposition? The value proposition is basically the calculated future value of something, right? So if you have a good investment, then the value proposition is going to be positive. It's going to be higher than a bad investment, right? So when money is cheap, just about like if money is cheap and you knew that it was going to be cheap forever, then in a certain kind of hypothetical sense, just about any investment is going to have a good value proposition because people need to invest their money at that point. But when money becomes expensive and the stock market is less attractive because people are pulling the money out of it, a lot of malinvestment is going to fall apart because it was being propped up by the cheap money. And so malinvestment, we can take a look at it, but I think there's a lot of projects that have bad fundamentals, a lot of your ESG projects that simply are not cost effective. not from a true economic standpoint. Stuff like that's going to fall apart. And you have a lot of banks that have a lot of paper that's based on low interest rates. And when the interest rates go up, their collateral paper is devalued. The money that was holding up the banks before is now worth less. So their collateral is falling apart, which means they're not being supported. So we're in an environment where a lot of things are falling apart because the money is getting more expensive. So the real data is coming out a month after the data in a lot of cases. You'll see these positive numbers in what you're looking at on the screen. You see a lot of green numbers where there should be red, especially on the US side. And then like a month later, we hear, oh, no, we got some more data and the data wasn't as good. It's like, for example, right now, the non-farm employment change number came out, right? And so they're saying that more jobs were added to non-farm employment than expected. They expected 169,000 to be added. We actually ended up with 187,000 added, right? But then there's the unemployment rate, and the unemployment rate is actually higher than expected. See, it's and significantly so, about 10% higher than expected. The hourly earnings month over month. So we actually have a smaller percent rise in hourly earnings month over month. You're looking at a CPI that's been in the 5 and the 6 and 7%, and yet hourly earnings only went up by 0.2%. That's a stagflationary number. People are earning less and things are costing more, and it's shown in the numbers. And these numbers are fudged because we don't know for sure which numbers are fudged, but we find out after the fact that numbers are fudged. So the left, well, I don't want to say the left, but the current administration, let's say, is in a very tough position because they want to fudge the numbers to make the economy look strong so they can say they have a strong economy coming into the next election. But at the same time, they're in trouble because the stronger the numbers look, the more likely the Powell is going to keep hiking rates. And the more the rates get hiked, the weaker the economy and the market is going to get. So they're kind of in they've painted themselves into a corner, right? By, it's in a certain sense, it has a lot to do with timing. Sure, Trump, he had some good policies, as far as the economy, it went well while he was in, but the reality is that the interest rates were super low while he was in. They weren't hiking. In the beginning, they were hiking some rates, but he did fight to get rates down. That was a big thing for him. And the rates went down and the markets went up, and that's just how it was. There also wasn't us spending $100 billion on a war that we really shouldn't have anything to do with. So, there's a lot of things that were more proper in the Trump administration. Is that affecting the market? Maybe. But I would say that a lot of political kind of discourse about economy good, economy bad, it's downstream from economics. Economics is going to be what runs that game. So at this point, the left is the current administration is kind of at a bad time for the economy right now. And, unless something changes drastically in some very, very fundamental scenarios, then they're going to have a hard time convincing the public that they've done well for us coming up in the elections. So we are live every weekday, 8:30 AM EST, giving out free content. Come check us out on YouTube. Come talk to us. Go over to the website. That's www.algofactory.tech. Again, www.algofactory.tech. And for a limited time promotional offer, we are giving out memberships at $49.99 a month. There's a ton that we're offering over there. Come see what that's about. Also, you can see our Twitter link. All the links are up on YouTube. Come talk to us on social media. See us on the live YouTube videos. We hope to see you soon.